Hello everyone. Today we will discuss about Company Act 2013. There are companies. So one person company, private company, small company and etc. There are types of companies under Companies Act 2013. In one person company, the 2000 Act introduced a new type of entity to the existing list, that is, apart from forming a public or private limited company. The Act enables the formation of a new entity, a one person company, that is OPC. An OPC means a company with only one person as to its members. Private company. This Company Act 2013 introduced a change in the definition for a private company. The new requirement increases the limit of the number of members from 50 to 200. So this is very important thing. Then small company. Act also define a small company as a company other than a public company. So first, paid up share capital of which does not exceed 50 lakh rupees or such higher amount as may be prescribed, which shall not be more than 5 crore rupees. And second, turnover of which as per its last profit and loss account does not exceed 2 crore rupees or such higher amount as may be prescribed, which shall not be more than 20 crore rupees. So here we are talking about small company and its paid up capital and its turnover. As set out in the 2013 Act, a holding company or a subsidiary company, a company registered under Section 8, and a company or body corporate governed by any special act. So all these three companies will not be applicable the above mentioned provision. Now we'll talk about Dormant Company. The 2000 Act states that a company can be classified as dormant when it is formed and registered under this 2013 Act, Company Act, for a future project or to hold an asset or intellectual property and has no significance accounting transaction. Such a company or an inactive one may apply to the ROC in such manner as may be prescribed for obtaining the status of dormant company. Now we'll see the roles and responsibilities. So there are officers, there are promoters, there are members. So here if we talk about officer, the definition of the officer has been extended to include promoters and key managerial personnel. What is this key managerial personnel? The term key managerial personnel has been defined in the 2013 Act. So here, expanding the scope of persons covered by such as Section 2, subclause 51. Who are the promoters? The promoters has been defined in the following ways. A person who has been named as such in a prospectus or is defined by the company in the annual return referred to in Section 92 of Company Act 2013 that deals with the annual return, or who has control over the affairs of the company directly or indirectly, whether as a shareholder, director or otherwise, or in accordance with whose advice, directions and instructions the board of directors of the company is accustomed to act. Now we'll see independent director. The term independent director has now been defined in 2013 Act, along with several new requirements relating to their appointments, role and responsibilities. Further, some of these requirements are not in line with the corresponding requirements under the equity listing agreement. Now we'll see the investment. So subsidiary, the definition of a subsidiary as included in Company Act 2013, we state that certain classes or classes of holding company shall not have layer of subsidiaries beyond such numbers as may be prescribed. With such a restrictive section, it appears that a holding company will no longer be able to hold subsidiaries beyond a specified number. Financial statements. So here if we talk about financial year, so it has been incorporated on or after the first day of January of the period ending on the first day of March of the following year. In respect whereof financial statement of the company or body corporate is made up. So it has been defined as the period ending on the 31st day of March every year. What is this consolidated financial statement? So here it is to prepare and present consolidated financial statements in addition to standalone financial statements. Audit and auditors. So mandatory auditors and rotation and joint auditors. Non-audit services. Auditing standard. Cognizance to Indian accounting standard. Secretarial audit for bigger companies. Secretarial standards. Internal audit. Audit of items of cost. All these have been defined under the Companies Act 2013. Now we'll see the regulators. So there are tribunals and National Company Law Tribunal, which is very important to regulate the business or the transactions of a company. So in accordance with the Supreme Court judgment on 11th May 2010 on the composition and constitution of the tribunal, modification relating to qualification and experience of the members of the tribunal has been made. So there may be appeal from the tribunal to National Company Law Tribunal, that is NCLT. Then NFRA, that is National Financial Reporting Authority, according to Companies Act 2030, requires the constitution of NFRA, that is National Financial Reporting Authority, which has been bestowed with significant powers not only in issuing the authoritative pronouncement but also in regulating the audit profession. SFIO, Series Fraud Investigation Office. The Companies Act 2013 has bestowed legal status to SFIO. Merger and acquisitions. The Companies Act has streamlined as well as introduced concepts such as reverse mergers, merger of foreign companies with Indian companies, and squeeze out provisions which are significant. The Companies Act 2013 has also introduced the requirement for valuation in several cases, including mergers and acquisitions by registered valuers. Corporate social responsibilities, that is CSR, which is very important part under this Company Act 2013. The 2013 Act makes an effort to introduce the culture of corporate social responsibility in Indian corporates by requiring companies to formulate a corporate social responsibility policy, and at least incur a given minimum expenditure on social activities, which will be very helpful for the societal growth. Class action suits. So, Company Act 2030 introduced a new concept of class action suits, which can be initiated by shareholders against the company and auditors. Prohibition of association or partnership of persons exceeding a certain numbers. The Company Act 2013 puts a restriction on the number of partners that can be admitted to a partnership at 100. To be specific, the 2013 Act states that no association or partnership consisting of more than the given number of persons as may be prescribed shall be formed for the purpose of carrying on any business that has for its object the acquisition of gain by the association or partnership or by the individual members thereof, unless it is registered as a company under this Companies Act 1956 or is formed under any other law for the time being in force. So this is very important, and there are exceptions, and the restrictions would not apply to the following: a Hindu undivided family carrying on any business, an association or partnership, if it is formed by professionals who are governed by special acts like the Chartered Accountants Act. Power to remove difficulties. So the central government will have the power to exempt or modify provisions of the 2013 Act for a class or classes of companies in the public interest. The relevant notification shall be required to be laid in draft form in Parliament for a period of 30 days. So here it is very important thing: insider trading and the prohibition of on forwarding dealings. So the Companies Act 2013 for the first time defines insider trading and price sensitive information and prohibits any person, including the director or key managerial person, from entering into insider trading. Further, the Act also prohibits directors and key managerial person from forwarding dealing in the company or its holding subsidiary or associate company. So here this is the very important information regarding Companies Act 2013. So in the next lecture we will see the detailed topics of our syllabus. Thank you one and all.